or want to sign that subscription form, you can find the Verdant Capital stand on level 2. I think it's level 2. I'm lost. I think we're way underground. I don't know which floor we're on, but I think it's the floor above us. Thank you. Delightful to hear about a fund that's actually keeping at the forefront of their minds the SDG goals, which I find quite unusual. So thank you for sharing that. We now move on to our panel, which is entitled The Evolution of ESG in the Investment Process. And I'd like to call to the stage the panel. It will be moderated by Nadia Coulibaly, who's the Head of Research at AVCA, the African Private Capital Association. So would you like to come up on the stage, and hopefully you've got your mics on. And I might add, if you've got any questions, keep them at the end and we'll have a roving mic going around, and please put your hand up and do say your name and which company you're from. Thank you.
Thank you. I think we're just trying to set an order. Yeah.
Oh, okay.
Pleasure.
Ollen, how are you doing?
Can you hear me? Hello? Good morning, everyone. So, my name is Nadia, Kouassi. It's my pleasure to moderate this panel this morning. And welcome around the table expert on ESG topics. So, I will introduce them. So, let's start by Bartu van Slingland, right? Who is managing partner at XML Capital. So with over 25 years of experience in investing, corporate restructuring, and general management in emerging markets, Europe, and the US, his current responsibility includes overseeing XML portfolio of investment and fundraisings. Right? Ollen, Machimbirike, who is vice president working at Verdant Capital Investment Management Division. So he has exceptional experience completing investment in inclusive financial institutions in Africa. Basil, Moftah, who is general partner at Nclude. He is an experienced company builder who works with founders to create disruptive companies with an enterprise technology focused in MENA. Right? And Basil is also an advisor, investor, and board member at numerous global technology companies. Wairimu, Karanja, who is partner at Persistent, so Africa's climate venture builder. So with 15 years legal experience in leading African and international firm, Wairimu managed the corporate, legal, ESG, and compliance matter at Persistent, right? And you also work with the investment teams and support entrepreneurs with venture building advice. Sophia, Omar, who is program manager at Impact Investing Institute. So Sophia leads the Institute investor-specific work streams with a focus on financing a just transition in the Global South and enabling pension scheme and charitable endowment to become impact investors. So, before we dive into the trends of ESG consideration in the investment process, I would like to set the stage with a basic question. So why is investing with sustainability in mind is so important at first, and how has interest in and practice evolved over the time? So maybe a question for you, Bartu.
Yeah, I think in our case, and maybe a bit of background on what we do. Is this, can you hear me? Yeah, that's better, I think. So we focus on SME investing in frontier markets, SMEs in DRC, Uganda, Angola and Zambia from next year onwards. We've raised 3 funds, we're raising our 4th one now. We exited with a DPI over on our first fund in really frontier markets, which I'll get to in a moment. What we've seen is a gradual development because we started as a startup as well ourselves 12 years ago in 2010 with our first fund, which was really suboptimal. And then you don't have the scale and the resources to do everything that you're expected to now to do these days. So there's been really a development from fund to fund to get that ESG capability improved. And since last year, or since this year, we have an ESG manager. That was not the case in the last 11 years when I did it myself with a few people. So I think that's one element of growth and the company growing to do more. And then in terms of the capacity, I think what we see in our markets, which is probably not dissimilar from other markets, is that in Africa, and it goes back to Edmund's points earlier, it really, you start from a low base. So you really need to help these smaller companies to get a basic ESG compliance, or at least the basic things need to get in place, and you help them with that, and that's what we do.
Thank you. So let's have a look at the founder perspectives. A question maybe for you, Wairimu. So in addition to managing ESG and compliance matter at Persistence, right, your role also involves working with investment team to support entrepreneurs. So how important are ESG and impact consideration among the founders?
So ESG and impact considerations are very important for the founders. But what we found is that because the founder is also the CEO, the founder is also the one looking at the financial aspects, even though they're front of mind, and that is why they set up their business, they may not necessarily have the skills to manage ESG or even to think about what it means in terms of fundraising, which is why we provide a lot of that support, because you have 24 hours in a day, 12 hours of a working day, and there's only so much we can do. So they are very important. They are the central reason why these founders have set up their businesses, in order to have that social economic impact and to have that climate impact. But they need assistance in taking on in-depth operational roles and venture building in order to be able to have the systems and the processes in place to manage their ESG processes.
Thank you, Wairimu. Sophia, so now you're working in another space, I would say. So the Impact Investing Institutes play a critical role, right, in promoting investment, impact investing. So how do you see the role of organizations like yours in fostering the integration of ESG considerations?
So, the with its effectiveness, and we work with who both looking at growing market in our own market, high level ecosystem approach. I think the role of our organizations is really okay. The role of my kind of organization, so the Impact Investing Institute, sister organizations globally, is really to take that very zoomed out view. Let's just take the look on mic and use the handheld. Yeah.
Sorry.
Is this better?
Yeah.
Oh, thank God for that. Nothing like tech issues on a Monday morning. Do you want to ask the question again, and I can start again?
Also, the role of organizations like yours.
Yeah. Yes. So the role of organisations like mine and our sister organisations sort of around the world is really to take that zoomed out view of the market. Why isn't the market growing at the scale we want it to grow at? You know, the funding gap for the SDGs, I think, was estimated at 3.8 trillion annually. That's huge. That's so much money. Obviously, I'm biased. I work for the Impact Investing Institute. We think impact is important. But that is a huge, huge opportunity for genuine impact and financial returns. So at various stages, why you identified the fact that founders are critically interested and driven by this, but they don't have the time, the resource to articulate that drive to funders or to investors. Investors are interested, they don't know how to measure, manage, report. At the institutional level, there's a lot of concerns around fiduciary duty. Impact investing in many ways is new for a lot of people. It's a market that is growing. And when a market is growing, new issues are thrown up. And it's the role of my organisation and others like us to really look at what are the knowledge gaps, what are the tools that we can provide to shortcut some of those issues. So, for example, we have a big focus on the just transition to net zero and what it means to invest for a just transition to net zero. We have a coalition called the Just Transition Finance Challenge, which is a coalition of 21 investors and financial institutions globally, with assets under management of about 4 trillion. And with that coalition of investors, we've developed something called the Just Transition Finance Criteria, which is a tool that fund managers and asset managers can use to develop or indeed benchmark existing products around the just transition. So things like that. What are the policy recommendations we can make? What are the shortcuts that we can help build this market?
So how can impact-focused fund manager incentivize more pension engagement and participation?
It's an excellent question, and one I think that we all ask every day in many ways. I think it's really important when thinking about pension funds is to understand your audience and understand what they are concerned about. I mean, my primary conversation that I tend to have with pension funds is around their fiduciary duty and saying things like, thinking about impact or ESG considerations is outside the scope of my fiduciary duty. I don't believe that that's true. I think the duty of a pension fund trustee is to act in the best interests of their members. That means, A, taking into account all things that are financially material. So ESG is quite a broad church. It can mean looking at ESG from a risk management perspective. It can mean looking at ESG integration in order to generate genuine long-term sustainable impact. So if you're not looking at it from a risk management perspective, you're failing in your fiduciary duty at bar one because you're not taking into account some of the biggest risks of our time. But also, what is the best long-term interests of your members? Some of your members will be 18. In 20, 30, 40 years, if we're not seriously thinking about how to mitigate and adapt to the climate crisis and how to contribute to the Sustainable Development Goals, that's not their best interest for the long lives that they're likely to lead.
Thank you, Sophia. So now let's talk about the investment opportunities. A question maybe for Ollen, right? So the Verdant Capital hybrid funds, so which target fintech and financial institutions, has identified compliance with high environmental and social standards. So how has ESG integration shaped the Verdant Capital investment strategy and this selection for the funds?
All right, great. So, yeah, I think first of all, the our hybrid fund has got $4.5 million technical assistance facility, and we are Pan-African. We focus on funding financial institutions based in Africa. Now, there's so many areas that we look at from ESG perspective. We do have our own, ESG manager, Johnny Woy, who is, focused on, conducting ESG DD on each and every one of our investees. Now, why do we do that? We want to identify gaps in the ESG area. When we identify those gaps in ESG, we assist our investees to close those gaps. So we do have an ESG action plan that may come in as a condition subsequent to closing our investment. We just don't close our deals and then we leave it like that. We want to make sure that our investees create a good reputation in the communities they operate in. They create good ties, positive relationships with external stakeholders, the government, the communities, the general people, the borrowers, most importantly, because the borrowers are the ones who are driving your the growth of your loan portfolio. So apart from identifying those gaps, we also assist our investees to to do some social rating and client protection principles, which is very, very important, right? We do have external consultants that we work with, the likes of microfinance, that make sure that investees are compliant with the client protection principles. Why client protection principles, as I mentioned, borrowers are very, very important in your loan portfolio. If you don't maintain a good relationship with your borrowers, how are you going to run your business? You're going to damage your reputation, you're going to lose business, and that will impact us as an investor. We are coming in as an investor, we invest in our investees. So we want to make sure that our investees are client protection certified, they get a social rating. During the social rating process, external consultants such as microfinance are there to identify gaps in the client protection area, and then create an action plan for investees to work on, fill those gaps, and make sure that you have a good reputation that stands with your borrowers and the general public.
Thank you, Ollen. Maybe Basil, so from an early stage company landscape, so how do you integrate this ESG consideration when dealing with early stage company?
Yeah, so I'm gonna go on the controversial side. We don't. And the reason why we don't start with ESG is because at early stage companies are, what's the right word, focused a lot more on building their product, building their solution, and so on. Where it's embedded is really in the investment process. So the overall fund theme is around financial inclusion. And the way we think about it is like by looking at the value chain of the financial services sector. We focus predominantly on lending, micro-lending, we look at savings products, we look at payment solutions, etc. Everything that enables unbanked and underbanked populations and SMEs to enter the banking system. The way we've approached it is by trying to work with our portfolio companies to work with each other. So that gives you kind of a multiplier effect. The realization that in technology is moving so fast and so rapidly that you have to bring together those technology solutions in a complementary way rather than a competitive way. So much money, I think there was a slide by your colleague earlier about 2.5 billion has been put into fintech and only 500 million has been put into microfinance or some comparison and so on. A lot of money is wasted in technology companies trying to rebuild existing solutions, if you like, or rebuild what's already out there. So having complementary solutions, having the founders act as a community together, we think has the biggest impact in some ways on bringing the solution. Here's what I would say. I think anytime you put ESG or impact in front of a founder as a condition of investing or as a condition of raising money, you're going to hear the answer you want to hear. You're not going to hear the answer that you would like to hear. What we would rather do is sit with a founder, understand what problem they're solving, and decide for ourselves if that is yielding the results and the impact that we're looking for, and back them. And then, of course, we measure. Of course, we take the time to work with those founders to understand how many jobs are created, how many loans, how big is the loan portfolio, what's the multiplier effect on economy, et cetera, gender, and all of these things. But we don't believe that putting it as a criteria up front with early stage companies actually gets you the best results, but rather being conscientious about how you go about making those investments.
Maybe Basil, so you work in different regions, and I'm curious to know if there is any differences in terms of context. So how do investors need to consider context when determining social and environmental impact they hope to achieve through their investment?
Yeah, I think a few points that Basil was making are interesting. We are doing more growth capital, so that's a bit of a later stage. It's promoters, entrepreneurs, and their companies who've already been around, and in some exceptions you do startups, or we invest in startups. What you then have is at least some footprint of, if you do a categorization in terms of ESG of what they are. What you do see is that our investors, which are mostly development banks, have their whole long list of requirements that is changing regularly. So if you compare it for Fund 1 with Fund 4, there's been an enormous evolution. And what we see, and that's not necessarily a good development, is that there's a tightening up. So sometimes we feel limited, and it goes a bit back to Basil's point, is we feel limited in doing investments because our investors are thinking, well, we shouldn't do it because there may be too much of a risk, reputational or in other ways. Anyway, we've found a middle ground, but I think that's one element, and that has more to do not necessarily with the region or partially the countries you're operating with, because the environment may be a bit more tricky, but it's mostly the type of business you invest in. So I think for an SME, a growing company, that's a different story than for a startup, and then it depends per sector. But we can go at length into ESG and all these things. I think with every one of us, the part of the investment process is to check where do things sit, where does this company sit in terms of the action plan we made with them, how do we improve, and then what we try to do is the companies that are more, where the sector is more able to make changes. So for example, in a hospital in Kinshasa, you have to go through a whole range of social and it's about patient safety, etc., etc. So there's a lot of things that you have to do that are not relevant for a call center or a service sector company. So we try to tweak it depending on the type of sector, and then have examples and then help in our portfolio with examples to have others that are not as far there to improve on their end.
Thank you. So yes, impact and profitability is always a topic of debate, and I'm curious to hear your voice on that matter. Maybe Wairimu. So from your perspective as an early stage investor, right? How do ESG impact investment return capital?
Well, Persistent invests at the early stage, at pre-seed and seed stage. And we have seen a direct correlation between how we look at impact and how we look at environmental, social, and governance issues and issues of investment returns. There is, I think, considerations of, well, do you achieve impact or do you achieve profitability? But certainly from the African context and in how solutions are shaped, you can't, in any business, there is impact or there has to be impact in order to have that market attraction to be profitable. If you think of e-mobility, right? If in order to be able to get a boda rider, we call them bodas in Nairobi, in order to be able to get them to sign on to get an e-bike, they need to think about, they may not necessarily be calculating, okay, how much am I going to earn every day and how much school fees can I earn, but they'll be thinking, will I be able to make enough saving based on this payment plan that I have? And that contributes to the value.
It's everybody's nightmare.
That is interesting. But that contributes, it's a direct correlation. And then if you think of, especially, for our fund, we say we're going to achieve, which we have based on our track record, 15% net IRR. But you have to balance with the impact of the lives improved, the jobs created, the gender impact that you're going to have. If you think of, off-grid solar, CNI solar, you achieve a great amount of impact for the unelectrified on the African continent. But in order for the company to be profitable, they have to show their customers that they will have that social impact, that there will be jobs created. So there is that direct correlation. And I think my challenge to everyone in the audience is maybe do not so much separate impact and profitability, especially when you're looking at the African continent in terms of your investment. They are intertwined. And I think that's why we're very passionate about our investment, because you can't really separate the two. You have to put the two together if you're going to have investment returns. If you think of M-Pesa, banking the unbanked, they have had significant impact in terms of entrepreneurs created and jobs created, and they've also had really high returns. If you think of solar home solutions companies that have made it on the continent, really high returns but connected to the impact that they've had.
Thank you. Ollen, do you want to add something from your experience on this question?
Yeah, maybe I can say, from our side, the investment in ESG-related matters brings returns to us, like indirectly, because the ESG areas that we focus on, the things I mentioned, for example, encouraging our investees to develop, ESG policies, encouraging our investees to have an ESG manager, someone who is well experienced in the ESG world, is very, very important for investments. And I think from our experience with financial institutions in Africa, most of them, they do not have a well-developed or formalized ESG policy in place. They don't have an ESG manager at all. So we are there to make sure that we bring some light across those areas whereby our investees are required to to have an ESG manager in place, develop an ESG policy that guides all their ESG-related activities. I think it's about creating a good reputation in the market. As I mentioned earlier on, if you create a bad reputation in the society, who's going to work with you? Your suppliers. You need operating licenses from the local authorities. If you don't have a good reputation with them, you risk losing your licenses. Now your investee, if you lose your license, what is going to happen to our fund? So we need to make sure that our investees create a good reputation in the market, treat their clients very well, because the borrowers are the drivers. They are the king, they are the drivers of their business. If you build a good reputation in the market, you're going to grow your business. You're going to get more borrowers on a daily basis. You're driving your portfolio. You're making your clients happy. They'll repay you. They will settle their loans. They'll settle their loan repayments in a good manner. So I think, across the board, we do have a very good, performing investees. The likes of Mogo, Watu, LOLC, they're doing very well in terms of loan portfolio quality. That reflects that their borrowers have got a good repayment behavior. When the financial institution is getting paid well, we're getting paid well. If the borrowers are not paying well, we're going to have challenges in terms of our investees repaying our loan, because they need to generate cash flows from their borrowers. When they generate more cash flow, it means they're able to settle our debt. I think from that angle.
Thank you.
Yes.
Bartu, do you want to add?
Yeah, I think these comments, it's the same for us. At the end, you invest, whether it's a financial institution or an entrepreneur and their business. If they don't have a good business, that is, of course, you need to, all the compliance with local regulation is important. Then taking it a step up, and then we feel it's more like doing good housekeeping to have a business in place that is well organized, and that includes the environmental, social, the governance side. The governance is often, with these type of business, a little bit later in the context, but it's also important. And you see it in repayment behavior, because we do quite a bit of debt, so it comes back there. That may also have to do with liquidity in the market, but if that is okay, then it's really about, is this a well-run business? Do they do their treasury management in time? Do they have the right clients that come back to them, etc.? The points Ollen was making. So that is key. And then I think the other part is that if you have an equity stake, and we do minority equity stakes with debt, so we want to be dependent on the promoter to be the right horse that runs. But if you then have a minority stake and there's an exit to a third party, then having your housekeeping done well is also important, because an international buyer, we have now one case in DRC where a transport company has probably been taken over. They are better organized, and therefore the price of that asset is going up.
Thank you. I will pause here and give the floor to the audience if you have one or two questions for our panelists. No.
To me, to my mind, good morning. part to my mind, ESG collection is also about data collection, and I wonder where in the process does that fit for you in the investment process? Is that an upfront cost? Is that an ongoing process? How do you manage that cost, or how do you manage that kind of data collection? Because otherwise, that's part of the story. That's everybody, whoever wants to answer that.
I'll answer it for the early stage. It's really a journey that starts from day one. I would probably bucket it into 3 buckets in a very simplistic way in my mind. One is, do no harm, right? So what are the things that you're doing in your business that are having an impact negatively, if you like? Then there's the common sense part, which is, things like being up to date with regulations, being up to date with all of the elements of society that you should do. And then how do you make a difference, right? And what is it that you're changing? And if you kind of, instead of sitting and thinking about all of these, impact and all of the different frameworks, if you just follow, in our minds, those 3 very simple steps, you can very quickly assess the company and where it sits and stands, right, in terms of investability. And then from there, I think you mentioned this, you start to develop it. In my case, if somebody has an ESG officer already, I'm usually very suspicious, because early stage companies shouldn't have an ESG officer already. Makes me think that they're there just for fundraising purposes and not for the real, not for the real essence. But the mindset of an entrepreneur tells you very quickly how they think about themselves and how they think about their businesses. Most entrepreneurs have a passion, or at least the investable ones have a passion that makes you want to make a difference with them. And that can be measured in multiple different ways. The challenge is putting in the right elements and the right methods to do that data collection, if you like. And that's where it's been very challenging. There's no standards. It's very subjective. If anything, it's open for corruption, right? And so, hopefully through time and through institutions that are being set up, we'll achieve some level of alignment across the industry, but I'm a bit doubtful at this stage.
So yeah, I think especially on data collection, the alphabet soup is a nightmare, and it makes it very, very difficult to understand who wants what you legally have to do, in which jurisdiction, what kind of investor, and what kind of investor. And you spoke earlier about DFIs and their very inflexible mandates. I think that's a massive problem. They need to be a lot more flexible, especially if they're looking to achieve genuine impact. These DFIs, multilateral development banks, catalytic capital providers of all sorts need to start really thinking, if quality data is a barrier for you investing in projects that are genuinely impactful, how can you provide capital to ensure that that data collection is in place, and that you put the onus not on the investee companies, not on the fund managers who you're investing in, but you say, here's how we're going to help you get to that point. And I think, that's, we've actually just about to publish a report on the kind of uses of catalytic capital in emerging and frontier markets, with a particular focus on the African continent, and lack of quality data was an off-cited barrier to entry for investment. But actually, that's something that you can do something about. Stop putting the onus on the wrong person or the wrong organization, I would say, is a big piece.
I can pick up from that from a process perspective, because as Basil said, you can't really focus so much on especially startups and how they look at ESG and their processes. But when we are, for instance, if I can say, starting at screening a company, we have a simple questionnaire. It's not complex. You can answer it in 5 minutes, about how you look at ESG. Because ESG as a term, when someone thinks of ESG, you think, oh my God, it's expensive and burdensome, and I'm going to spend so much time and money thinking about my ESG processes. But if you answer the simple questionnaire, the inherent things about, do you consider gender in your company or in the product that you provide, then you realize, yes, I do, and we actually have staff, or we don't have staff, but we'd like to have staff. or do you consider supply chain risks or environmental concerns, then it becomes front of your mind. Some of the things that are missing, do you have governance principles? Do you have a board in place? We take that as opportunities, because if you don't have, then we're going to help you when we invest to set up the board. We're going to have one of the original board members in there. We're going to give you board rules. So that's in screening, and in due diligence, we're going to ask those questions, and then it becomes front and center. Part of what it does is it demystifies the concept of ESG for startups, and it also makes you realize that it's important not just for fundraising, but also in assessing whether your company is achieving the impact that you want to achieve. And then how we build on that to further help the company develop its processes is having quarterly reporting, because now you know, for instance, impact metrics that you need to look out for. So we've got impact metrics for, commercial and industrial solar. We've got impact metrics that we provide the companies for electric mobility. And so even though you know, and you've given us in your model and in your business model how much diesel is being displaced by your e-bike, it's now very clear that, okay, these are the jobs that we are creating and these are the lives we're changing. And through that quarterly reporting, it becomes ingrained in you that this is the ESG process.
This is what's important.
And this is what is important. So by the time we're getting to your Series A fundraise, you basically have your ESG due diligence pack ready, and you don't have to worry about the fact that you don't have a board, or you don't have board minutes, or you don't have governance principles, or you've never really thought about end of life for your batteries, or you've never really thought about the 2X challenge. It's very clear, and a later stage investor coming in, because you can't escape that is going to be their requirement. They have to tick their boxes, and you'll be ready for that. And that's part of the biggest value that we provide to our, especially African founders in our investments. The fact that we bring it front and center in their brain that these are the considerations to make in ESG.
Just 2 words from mine. So this is more growth capital. There's a cost to it. It's very simple. It leads to management fees in a way. And I think in Africa you have funds that are, if it's not the larger PE funds, that are on a global scale still maybe not as effective or cost efficient as really large asset managers. With smaller funds, that's definitely the case. In our case, we had a first fund of 20 million, and then your management fees are going to be higher because of the locations, all that stuff. So there's that element. I think we make a distinction because it's growth capital between ESG and impact. On the ESG side, we have, which was said before, you have an ESDD questionnaire that's been updated, etc. So that's part of what the team does. You don't hire external consultants for it. We typically do that at the stage of implementing management systems for ESG. And then there is a cost, and TA was also mentioned in the past, is where we do a split between the company and us. So they don't put it in, it's important, but it's not urgent, and then it never happens because they have 10 other things on their list. And it moves to, okay, we can do it now, someone is helping us to pay half of the cost of that consultant, and then you start to push it forward. But that's a bit the approach.
Thank you, Berthoud. So thank you. So we're coming to the end of our session. Thank you again for this enriching conversation. Sorry, I think we have, because I heard the bell, so I thought, okay, sorry.
Can I add something to this?
Okay, that's fine. Sorry.
Your question has just sparked a bigger conversation. So we have 10 more minutes, by the way. So we're gonna use it to just keep talking at you.
Just to be clear, so that first bell is at 5 in the morning, and then it'll be until.
Okay. No, but if I've had the privilege, if you like, to invest globally, and if I was to mention one thing about Africa that really needs a lot of focus over the next period, it would be around governance. I think it got mentioned kind of subtly and all, and I know once you pick on something, somebody's going to be out there, but what about sustainability and what about to me, and it's a very personal opinion, the fundamental flaws that we're starting to see in the breakdown of at least technology companies and early stage companies has all been around governance, okay? A lack of an active board, a lack of actually transparent, clear reporting. You know, these are cases that have a major ripple effect on investment. Because when you hear about a startup that, you know, there's suspicion around how it was governed or what happened with its, you know, financials or sexual harassment cases, any of that stuff, it doesn't really matter what the story is. The reputational damage that happens to the entire continent, for that matter, is very large, right? Because all of a sudden it's, oh, there's no good governance, nobody's oversighting the companies and so on. So I think, you know, I think everybody wants to say that, you know, ESG things are equal, or, you know, the SDGs are all of equal importance. For me personally, just in the area that I focus on, I found governance to be of a very, you know, to be the most critical, at least in the coming period.
We have another question.
So if we're to look at the continent slightly more granularly and we look at on a regional basis, what do you guys see in terms of adoption across the continent? Do you find that maybe East Africa is slightly ahead, or generally what are your thoughts on that? You guys that do deals across the continent.
I think you're right. Saying that some markets in East Africa are more ahead. I think Kenya is, to a certain extent, if I compare to the DRC is now part of the East African community, but there are big differences between the two in terms of governance. There's also a number of similarities. So certain markets are seen as very high risk, and if you're on the ground and you have the information, it turns out to be less the case. But you also, I think in South Africa, maybe you see something that was really good and it's been going downwards. So I think it's a mixed bag. You have to go into each market and then work out how it plays. The governance bit with the government is one thing, with corruption or taxes, tax harassment, all those things. And then with companies, it also depends a bit on if it's a smaller, a startup company, a company that's in growth, an SME, or a more established company. So I find it always difficult to just take a broad stroke and say, well, the continent or this area, you need to look more at specifics, but I think in general there's a lot of room for improvement, if that helps.
Okay. Yes, thank you. I think we have.